It's time for Yahoo Finance's Market Minute. Stocks sinking as the first quarter is coming to an end. The tech-heavy Nasdaq leading the broader market losses, down nearly 2% here. Nvidia leading the tech sector lower after President Trump said he will not be granting any country softer treatment when it comes to reciprocal tariffs. Nvidia is set to feel the impact from 25% tariffs on goods from Mexico and Canada, as well as those reciprocal tariff shares down nearly 5%. Tesla also under pressure, down nearly 6% today as protest against CEO Elon Musk and his role in government continued. Tesla is expected to release its Q1 deliveries on Wednesday as analysts at Stifel trim their near-term delivery forecasts ahead of the release. CoreWeave falling sharply on its first full day of trading, the AI firm opening at $39 a share Friday, just below its IPO price of $40, now being hit by the broader market sell-off. That's your Yahoo Finance Market Minute. For more on what's trending, scan the QR code to track the best and worst performing stocks of the session.
Welcome to Wealth. I'm Julie Hyman in for Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. On today's show, Portfolio Checkup. I'll talk to a portfolio manager about how you should think about positioning your portfolio heading into the second quarter. We'll also dig into the tech trade and discuss whether now is the time to buy. And getting retirement ready. I'll talk to an expert about how to most efficiently withdraw money in retirement. Plus, all week on Wealth, we're talking about student loans ahead of the 2025-26 school year. We'll dig into all things FAFSA, loan advice for current and incoming students, and break down how to make your first student loan payment. First, we take a look at some of the market action 90 minutes into the trading day. Stocks now turning mixed, actually. The Dow just in the past few moments bouncing into the green, although it's up just marginally about 16 points. The S&P 500, though, did hit new intraday lows for the year ahead of President Trump's rollout of tariffs expected this week. Of course, markets have had a volatile couple of months, with all three major averages set to close out the first quarter in the red here. Right now, we're recovering a little bit from the lows. Our next guest says we are likely to see more chop ahead. Here to dig in is Thomas Martin, Global Investments Senior Portfolio Manager. Thomas, thanks for being with us here today. Obviously, this volatility has been persistent because we don't know what's going to happen with the tariffs here. So how are you thinking about it? How concerned are you about the picture going forward given the tariff outlook?
Sure. Well, thanks for having me on your program, Julie. And I think it's important to think about what your portfolio was positioned like before we got to this point, and what it's meant for, what you're trying to do with that money, and how your time horizon fits in with that. Obviously uncertainty has made the market very, very choppy and go down. A lot of folks were hoping that a 10% correction, of which it was barely 10%, was going to be it. And all the technical indicators were saying that the market should bounce from here and go back up. And most of the sell-side firms were not really raising their predictions of a recession, although some did start taking down their price targets for the markets in the S&P 500. But we had that bounce, and now we're getting what you would call a retest. It's not just technical. It's following the fundamental information and the fundamental uncertainty that we're getting with regard to tariffs, as people try to put their arms around, their minds around what will be the financial impact on the various companies. So it's a very unsettling time. And
we're already seeing earnings estimates come down for companies, right? We're going to get into earnings season in earnest in a couple weeks now. So even after we get the announcement of more tariffs coming this week, do you think then the markets are going to be kind of bracing themselves for earnings and for commentary from companies?
Well, absolutely. And, you have the tariffs themselves, but you also have the question of the consumer and their ability to spend and their willingness to spend, even absent that, much softer. And the consumer has been resilient, but what their outlook is can impact their behavior. And we saw a fair amount of that coming through in the first quarter earnings. Not so much in the earnings themselves for fourth quarter, but in the guidance for the first quarter. So now that guidance, which has been lowered for the S&P 500 from an 11% or so growth rate down to 7%, and I think you saw some of the firms going down to 3% for the first quarter. So we've gotten some whiffs of that, and stocks did not react favorably to macro concerns of the consumer. So when they report those first quarter earnings, the question is, did they lower their guidance enough, or are they going to come in below that? That would be disappointing, of course. And then what's their guidance going to be for the second quarter? And then their guidance for the full year of 2025 will be even more telling, because now they will have had more time to see if the damage that they're experiencing in consumer expectations has some legs for later in the year.
So, Thomas, recognizing what you said at the beginning about different people having different investment goals and time horizons, when people are looking at their portfolios this year and they're seeing losses, should they just sort of double down and not do anything, right? Should they add to some of their favorite picks, or should they exit even some of them, seeing that they don't want to maybe risk losing more?
Yeah, I think that people want to think that they should be doing something in their portfolio. And when things are this volatile, if your positioning was correct for your risk tolerance to start with, you probably shouldn't be doing anything. At most, if you're taking withdrawals out of the portfolio, you continue taking your withdrawals to support your lifestyle. And if you have new money flowing in that can be invested, you invest that over time, especially in environments like this, so that it's not all going in with the markets up or down. And so you need to not panic and make sure that your portfolio is diversified. You're not overly indexed or positioned, all in growth or all in value or all in small cap, et cetera. But if you have a diversified portfolio, it should work out over time to meet your needs.
Don't panic. Good words there. Thanks a lot, Thomas. Appreciate it.
Great. Thanks very much.
Thank you. Now time for some of today's trending tickers, and you can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we've got Yum Brands. It's announcing it's looking for a new CEO as current head David Gibbs plans to retire in the first quarter of 2026. Gibbs has been CEO for 5 years and at the company for 36. Shares of Yum have risen over 50% during his tenure, and Gibbs will continue to lead the company through that search process. Next, Corcept Therapeutics. It's soaring after announcing its ovarian cancer drug met its main goal in a late-stage study. The drug, in combination with chemotherapy, led to a 30% reduction in disease progression compared to people treated with chemotherapy alone. This finding is for people with platinum-resistant ovarian cancer. It's a type of cancer that no longer responds to chemo treatments with platinum-based drugs, which are typically therapies given to patients first. And finally, Bitcoin miner Hut 8 Mining is rising after announcing a new venture with the Trump family. Hut 8 is launching American Bitcoin Corp. It's a subsidiary of the miner that will focus exclusively on industrial-scale Bitcoin mining and strategic Bitcoin reserve development. That launch follows Hut 8's acquisition of a majority interest in American data centers. That's a company formed by a group of investors, including Eric Trump and Donald Trump Jr. And of course, this is just the latest crypto push from the Trump family. The president has vowed to establish a Bitcoin reserve. This week, Americans will get more information about President Trump's plans to impose tariffs on certain foreign goods. The president has dubbed April 2nd Liberation Day. He's teased reciprocal tariffs that would match rates charged by other countries, but he has already made one concrete tariff policy set to go into effect on Thursday. That is tariffs on cars. Joining me now with more is my market domination co-host, Josh Lipton. I'm moonlighting here in the morning.
That's right.
So it's nice to talk to you in this
It's
capacity.
nice. It's nice to catch up, Julie.
Yes, it is.
President Trump plans to impose a 25% tariff on imported vehicles into the U.S. Now, he is doing this because he wants to encourage more domestic manufacturing. B of A analysts say ultimately the administration wants to get a portion of that roughly 7.6 million imported vehicles to be produced here, which could mean, by their math, about 30 production plants, around 105,000 direct jobs, and potentially over 1 million total jobs. But that, of course, is a long-term policy objective. What are the more near-term potential consequences for American consumers? Well, I spoke with Jessica Caldwell from Edmunds. She says automakers will likely face increased costs throughout their supply chains, and that means, she argues, it is reasonable to expect that vehicle prices are going to rise. Though exactly how much, she says, tough to estimate.
There's a lot of moving parts here, and I don't think that it's going to be this vehicle has gone up, this vehicle's tariffed by this much, so the price is going to go up by this much as well. Because I think, firstly, automakers will get rid of incentives. They're probably not going to have incentives of vehicles if they have to raise prices. They will probably absorb some of the costs themselves, see how much they can take, and then thirdly, start to raise prices for these vehicles. And I imagine it's going to look different for every brand and for every vehicle.
Two other important points Caldwell makes. One, many vehicle parts, remember, are sourced globally, which could increase repair costs for car owners, and insurance premiums will likely increase as any accidents involving new parts will see increased costs too. And two, she says, as new car prices rise, more shoppers are going to look to that used market, though she emphasized to me that there is limited availability, especially for near new models. Julie, back to you.
Thanks, Josh.
You got
Appreciate it. Coming up, how can retirees withdraw from their portfolios the most efficiently? We'll hear from a financial investor next on Wealth. According to a study from Allianz Life, less than half of Americans say they currently have a plan for how they will take income in retirement. And 45% worry about how to best take distributions from their retirement savings for retirement income. We want to help you out and discuss the best strategies for withdrawing that money in retirement. Joining me on set to discuss is Dominic DeAndrea, financial advisor for Dandara Wealth Management. So, Dominic, I guess let's start with the basic question here. When you hit retirement age, you may just assume that you can start withdrawing money as needed. I mean, I have to say, like, me personally, I put money in my 401k, and then it's just there for when I need it, right? But is that how it works?
First of all, thanks for having me, Julie. That's how a lot of people do it. And the problem is that if you go like that, and right now we're in a market downturn, so if you're taking money out in a market downturn and you want to continue taking that same amount out, well, your money's going down and you're taking out, so you're never going to have a chance to recover. So that's definitely not the best way to do it. There's definitely strategies that they should be looking at to make sure that they can weather market downturns throughout retirement.
Okay, so what's one strategy? What's the best strategy that they can use for that?
That's a fantastic question. So one thing is they should look at how they can get a guaranteed income as part of their income. So which a product like an annuity can work there. There's some income investments that can work there, where they get a guaranteed stream of income for the rest of their life on that portion of their assets. So they know on a monthly basis that their bills are paid, their day-to-day expenses are paid, they can live. And then they can still have some money that's playing the market because they want to know that when inflation happens and the market does come back, that they have those assets to grow. So a combination of both, instead of just pulling from the 401k, which again, could eventually hurt them. And if they live a long life, will eventually potentially go to zero, and then there's nothing to draw on, whereby having a guaranteed strategy, they know that that money, even when it hits zero, they're still going to get a check for the rest of their life, and depending on how it's set up, potentially their significant other's life also.
And then there's Social Security, and I'm curious about what role it plays and whether there are benefits when you're trying to figure out your whole income picture, whether there are benefits into delaying that receiving of Social Security.
Another great question. Absolutely. When I sit down with somebody, Social Security is a very key point in planning for future. Some people need it right away. Some people think they need it right away because they want to get their money. But sometimes it's better to take a strategy where they might take income off of their 401k, their 403b, their IRAs, and let Social Security grow, because that's the one asset that's guaranteed to increase from 62 up to age 70. So knowing that, we'll sit down and look at where the strategy works in. We'll get their Social Security payout numbers and run calculations and see, okay, if we wait till 67, and then we take that 401k money and then we put it back in the market, let it grow, and let it build again. Now they got a larger income to benefit. So I would never recommend anybody that's getting close to retiring or to just go take Social Security without sitting down with somebody that understands how to plan and how to package it with your retirement assets.
And does your Social Security get payout, if you delay it, does it get larger?
Absolutely.
On a monthly basis? Okay.
And after full retirement age, it actually increases by 8%. So 68, 69, 70, you get an 8% compounded interest on your money. So you're getting a guaranteed increase. I don't know where, I can't get 8% on, guaranteed, so that's why we want to delay it as far as we can.
And what about taxes on those withdrawals from your 401k once you get to that point? What do you need to consider there?
Well, I try to plan with clients when we're talking about our prospective clients, if we can see if we can potentially convert to a Roth IRA or start with Roth 403Bs or Roth 401ks earlier on in life or Roth IRAs, because what people don't understand is taxes come off those accounts. You'd be shocked how many people say, I got to pay tax on this money? Because they forget they didn't pay tax on it all along.
Right.
So we want to utilize taxes there. Another strategy that we can utilize with prospective clients is called the LIRP strategy. It's called life insurance and retirement planning, where you can overfund a cash value life insurance policy and pull that money out tax-free. So in conjunction with a CPA, we can see where the tax bracket will change and try to limit how much you're taking out of taxable and take the remaining out of tax-free or tax-deferred area, tax-efficient areas, so you can limit how much we give the government.
Dominic, thank you so much. I'm sure we just chipped the tip of the iceberg, but really interesting conversation here. Appreciate
Fantastic.
it.
Thank you for having me.
Thanks. Coming up, big tech stocks are off their recent highs, so is it time to buy that dip? We'll hear from a tech investor about the levels he's watching to potentially get back into the market. That's next on Wealth. Welcome back to Wealth. Let's get a check on the markets here because things are changing a little bit as we head through the morning. Right now, the Dow is higher by 93 points. It started the day pretty deeply in the red here. The S&P 500 is only down 0.5% now, coming up off the lows. I do want to point out, if you look at the intraday chart around the lows of the session here, that was the lowest that we have seen for the S&P this year. So we're recovering from those levels. And then the NASDAQ is down about 1.5% right now. Looking at the sectors within the S&P, what's driving us here? We are seeing tech, consumer discretionary, communication services. Those are the three worst performers. And then the tops here, XLP is consumer staples and energy and real estate as well. So a little bit of a defensive rotation here today. And then the other group that we've been watching very closely has been large cap technology here. With the exception of Apple, which is actually up about 0.75%, we are still seeing a pretty deep red here. Tesla, just one example, down by more than 4.5%. That's taking its declines for the year to close to 40% here. So it hasn't taken out its lows for the year, but it's near to it. Alphabet, Amazon, Nvidia in particular, Microsoft, Meta, all of them trading lower today as we continue to see the risk-off sentiment in the market. When it hits, it seems to hit tech the hardest. Well, speaking of which, nearly all of the Magnificent Seven, with the exception of Apple, are sinking in tandem with a broader sell-off in stocks. Our next guest is a tech investor on a self-declared buyer's strike, but he does say he's still bullish on the AI infrastructure trade. Paul Meeks, Harvest Portfolio Management CIO and Wall Street Beats partner, joining me now. Paul, it's great to see you, as always, here. You have been on a buyer's strike before when we talked. I feel like 2022 vibes is what I'm getting from you at this point. What's driving that buyer strike for large cap tech?
Well, I'm not necessarily worried about the AI infrastructure trade and how we might be at peak AI infrastructure spend. What I'm more worried about, and this is reflected more in my technical analysis than in my fundamental analysis, is the chance that the current policies pursued here in the United States could lead us to a recession. And if we have a recession, I don't want to say all bets are off. There'll be good buying opportunities among the carnage in that situation, but that's my greatest fear.
And what do you think the likelihood of that recession is? I mean, most of the base case forecasts we're hearing from economists is that there'll be a slowdown. But either way, how is that going to play out for large cap tech?
Well, it depends within large cap tech. Are you consumer facing or enterprise facing company? If you have a company like Apple, which is essentially dominant in consumer electronics, they might be under pressure as the American consumer and other consumers around the world pull in on such spending. But on the enterprise side, we'll see what happens. I think when we have our hyperscalers report their results, and they'll be coming in the next 3 or 4 weeks, I think they will confirm their capital expenditures for 2025, which is really foremost for AI infrastructure and continued data center build and large language model building and inference for AI. So I'm expecting, unless we have a real dour outlook on the economy between now and then, probably triggered by Liberation Day, that we should have a little bit of a pop in these stocks, a little bit of a recovery when those companies confirm their AI spending, and they'll probably do that within a month from now.
And Paul, our executive editor, Brian Stasi, had the chance to speak with AMD CEO Lisa Su about the potential for a slowdown in AI infrastructure spend. And here's what she told him.
There is no question we are in the very early innings of AI. Now, put some of the noise aside. So I am a big believer in this is the very, very early part of AI. The need for compute continues to be immense. We see that throughout all of our customers globally, and we're going to continue to invest strongly in this area because I think this is the single most important technology. I like to say it's the single most important technology of the last 50 years.
Paul, I feel like we keep hearing this, and I feel like it's not quite been realized. As she said, it's very early innings. I get it. But when are we going to get to even the second inning or the third inning in this situation?
Well, of course, whenever you talk to these tech CEOs, and I really admire Dr. Lisa Su for turning around AMD, she's absolutely brilliant. But they're always going to talk their book to an extent, right? That's just PR and IR. But I think that we're going to have an extended period of large language model building. We are starting to see some glimpses of inference. And once we get through the inference pipeline, then we'll see some hopefully pretty cool AI agents and AI apps. But unfortunately, when it comes to monetizing those agents and apps, I still think it's not a 2025 phenomenon. It might actually be next year.
And let's drill down on NVIDIA for a second here, because I know, going back to the beginning, you said even if you fundamentally believe in the case for some of these stocks, technically it's tough. So let's drill down on NVIDIA. What level are you watching there? How far down does it need to go before you think it does get attractive here?
Well, I think valuation-wise and fundamentally, it's very attractive. I was hoping for some stability around 104, 105. We're trading right there right now. But I'm not going to do anything before Liberation Day and all that hubbub. But I'm thinking 90 to 104, 105, where it's actually trading today, is attractive. Please don't buy it for the short term. We're not going to get a confirmation of how good their fundamentals are probably until late in the month of May. And so make sure that you buy it for the long term. But I agree that it's going to be a big, big hit from here. And I'm very comfortable owning it for the long term at that dip in price level.
Gotcha. Paul, good to see you. Thanks for joining us.
Good to see you.
Heading into April in the second quarter, we're taking a look at what investors need to know about the markets. Here with 3 things to watch is Catalyst co-host Madison Mills. Hi, Maddie.
Hey, Julie. Yeah, U.S. equities are underperforming so far this year, on track for their worst quarter since 2022. 3 catalysts to watch for a potential rebound: policy clarity, earnings, and flows in international stocks. Let's kick it off with policy uncertainty, particularly around President Trump's tariff rollout plan. Investors hoping for some clarity in early April when the fuller scope of the levies are set to be unveiled. One big question still: is this an escalate to de-escalate strategy, or will tariff policy be sticky? The answer could define where the market heads from here. Now, another area to watch: earnings. Analysts and companies have reduced earnings expectations for the first quarter, according to FactSet, amid concern about a slowdown in consumer spending. The S&P 500 is expected to report year-over-year earnings growth of 7.3% compared to 11.7% that was estimated back in December. That downward revision being driven in part by the tariff uncertainty. But still, the S&P is on track for its 7th consecutive quarter of annual earnings growth. And within earnings, investors will be keenly watching tech, as the Mag 7 is down 17% year to date. The final thing to watch in April is where Wall Street is shifting allocation as U.S. stocks are on track for their worst quarter compared to the rest of the world since the 1980s. Investors are looking at ways to hedge against that uncertainty. HSBC and Citi both downgraded their rating of U.S. stocks to neutral from overweight this quarter, while Barclays, Goldman, RBC, and Yardeni Research all reducing their S&P targets this year. Bank of America's March Global Fund Manager Survey found the biggest drop in U.S. equity allocation ever and the biggest jump into cash since March of 2020. That survey also found allocation to Eurozone stocks hit the highest level since July of 2021. So will the reallocation to stocks outside of the U.S. continue amid policy uncertainty? Well, some of our sources tell us the Europe trade, it's already run its course, with indices like the DAX up 11% year to date, compared with the S&P down about 5% in the same time frame. Fund flows could be a key indicator of global interest in holding on to U.S. stocks amid the current drawdown. And those are the three catalysts we're watching, Julie.
Maddie, thanks so much. Appreciate it. Coming up, what should you do with your tax refund? An expert gives us some tips next on Wealth. The IRS has doled out almost $163 billion in tax refunds so far this year, with the average person receiving nearly $3,300. That's up about 5% from 2024. So how can you turn your tax refund into long-term financial success? Joining me now is Jason Brown. He's a stock market expert at thebrownreport.com and author of the book 5-Year Millionaire. So tax refunds, which hopefully everyone will get, not everyone is lucky enough to get one, but what are the biggest mistakes that people might make with that tax refund?
I think some of the biggest mistakes that people make with their tax refund is just treating it like it's free money, and that using it to shop or spending it on consumer goods. When you think about it, that's the biggest check that most people get, and they only get it once a year. And so there's a unique opportunity, if they prepared or planned in advance, to put that to work in the stock market and invest it, and put themselves in a position where that money could generate roughly that amount every year versus just waiting for it from a tax refund.
So, and how do they avoid making the mistakes that you were just talking about?
Yeah, I think first it's about having a plan. And so if you're already behind the curve all year long, meaning you have credit card debt, consumer debt, or things that you've already gotten yourself into maybe a financial situation with, it's hard to then, when you get that chunk of money, say, don't pay off that debt. Or if you've been stressed all year, it's a little bit tough to say, don't take that vacation, because now your emotions are involved and you're like, I feel like I need it because this year has been so rough. But if they can kind of plan ahead, not get in debt, control their emotions, and then say, this year I'm going to do something different with my tax returns, which may mean not spending as much on Christmas gifts, may mean scaling back on birthdays or different things like that, to put themselves in a position where they can use that money to do something different.
Okay, so then when they're presented with that opportunity, they get that tax refund check, they don't have the debt, they're ready to spend it. What do they do, or invest it? What are some of the options? How should they be thinking about it?
Yeah, so that's why I said it all starts with making a plan. I always tell people, if you won the lottery, some people say, I'll invest my money once I have some money. I say, well, great. Well, if you won the lottery today, would you know what to do with the money? If I handed you $1 million, would you know what to invest in? I say, no, I'd go get educated. I say, so then it's not about the $1 million, it's about the education. So get the education ahead of the tax return. Get the education before the money comes, so you know what to do with it. And I would tell people to open what's called a practice account, where you can practice investing in stocks and practice investing in options. And you can get real world experience in a safe environment. So that way, when you get the real money, you'll already have a track record of winning or losing, and you'll already know how to buy and sell and what stocks you want to invest in.
And I guess also, if someone gets the tax refund, they don't have to, maybe they can, if they've planned, they can do both. In other words, maybe they can take the small vacation, but then use the rest of it to actually put that practice to work and put their money in the market.
You could. Big picture, there's no real success without sacrifice. And when you think about people's tax returns, it's $3,000, $2,000. When you start to look at the average stock, like Apple stock being $200 a share, I mean, you can only buy 10 shares.
Right.
If you had the whole $2,000. So now split that and you spent $1,000 on vacation, you only got $1,000 left. I think that's what discourages most people, because they don't see the big enough impact from investing a little bit amount of money. But if they understood the compounding interest and that little bit could grow into a lot if they made the sacrifice up front, they'd be willing to pay the price.
So it's really a mindset change that you're talking about here.
It absolutely starts with a mindset change. And they say personal finance isn't taught in schools, but that's part of the problem. If it's not taught early, then the mindset is what? Just spend it, I deserve this, I'm getting this back, I'm gonna have some fun. Or sometimes the mindset is, I'm okay making financial mistakes because I know this $2,000, $3,000 is coming back and I'll use that to bail me out. So we definitely have to change the mindset around tax returns, around getting into financial trouble early, and around planning for long-term success.
It's not a windfall. All right, I like that. Thanks, Jason, appreciate it.
Thank you, thanks for having me.
A programming note on today's episode of Financial Freestyle, host Ross Mack spoke with investor and educator Ian Dunlap, who shares his key strategies that separate successful investors from those who miss out.
I think the biggest reason we have a culture of gambling because we have a softening in the job market. When we were growing up as kids, there wasn't a great desire for gambling unless you were in oppressed areas like we were. But in massive America, the job market was strong, so the desire for gambling was very low. The job market is very weak now, contrary to the numbers. So that's why we've seen a spike in sports betting and trading. But any trader I ever asked, I'm like, okay, take your best parlay or your best trade. Do you wish you could have held it for 10 years? Do you wish you could have had a parlay on LeBron scoring 25 over the last 15 years? Everybody would take that trade.
To catch the latest episode of Financial Freestyle, tune in every Monday at noon Eastern on Yahoo Finance or wherever you get your podcasts. Coming up, we're talking to Rocket CEO about its latest acquisition. Plus, we kick off our week-long coverage of student loans with a look at applying to FAFSA. Rocket Companies announcing a deal to acquire America's largest mortgage servicer, Mr. Cooper, for $9.4 billion. This coming just weeks after Rocket announced its purchase of online real estate brokerage Redfin. Joining me now on the strategy behind these acquisitions, Varun Krishna, the CEO of Rocket Companies, and our executive editor, Brian Sazi, here with me as well. Varun, you have been busy for sure in the past month with these two acquisitions. Let's talk about Mr. Cooper first here. Mortgage servicing. Now, you guys have a mortgage servicing business. This will make it far larger. What's the business profile of that and the profitability profile, and what is it going to bring to Rocket?
You know, our vision, thank you for having me, first of all, Julie. It's great to be with you and Brian. Our vision is that we want to build an integrated homeownership platform. We want to make the entire experience of homeownership, from home search to origination to servicing, seamless and frictionless for our clients. And so we've learned a lot by creating our own servicing business. We have just about 3 million clients with Rocket, and we love, protect, and amaze them every day. It is a great business because when you build that kind of loyalty, you earn the right to recapture and generate new products and services for those same clients, which really improves the lifetime value. And that is really the theory of the case behind why this acquisition makes so much sense, is that we are connecting the best origination company in the country with the best servicer in the country so that we can create that recapture flywheel and create a long-term business. The other two things that are really interesting for us about this acquisition is that it provides us with more relationships and data that allow our models and our AI investments to become even more effective. And it also counterbalances the company to be able to drive growth in different market cycles, both high and low rate environments as well.
Varun, how did you identify Mr. Cooper, and how, I guess, fragmented is this industry?
Yeah, you know, the good and the bad news is that it's still a big market and it's still very fragmented. And, you know, Jay and I met, you know, when I was onboarding into the company, and I was learning from folks in the industry, and we just connected. And as I got to learn about the servicing business, you know, and talk with Jay and his company and meet his leaders, it became very clear that we shared a kind of a common viewpoint on where the world was going, and we wanted to create a better housing experience. You know, today the challenge we have is there's just too much friction in the process. You have to deal with too many middlemen. It's expensive. You know, there's a lot of wait and wonder. And so we felt that if we integrated our platforms, we could actually remove friction and we can create a better client experience for all. And when we thought about who we wanted to partner with, obviously Mr. Cooper is the best in the business. They have incredible size, incredible scale. They have world-class technology. And when we thought about who we wanted to partner with, I mean, the two companies have a very strong cultural alignment. They share similar DNA. We've collaborated together before. And we were, a group of common-minded folks who just wanted to work together and do great things together. And so when we compared it against all of that criteria, it really had to be Mr. Cooper. They checked every box, and we're excited to be able to work with them.
And to be clear, Jay is going to stay on after the acquisition, right, to continue to run that business?
That's correct. Jay is a world-class leader. I think he's built an incredible business. And I think he and his team really strengthen the collective talent at Rocket, and we're excited to have him continue.
Varun, one of my friends said this past week, and one of the houses they were looking to buy or kicking the tires on suddenly is up now 50, 60,000 because of concerns about tariffs and inflation. As this major macro issue goes through the economy, what do you think this is going to mean to the spring and summer housing market buying activity?
It's a great question. We keep a pretty close eye on housing. I think when you think about things like tariffs and inflation, it's still a little early. I think there are a lot of folks that are speculating. But let me tell you what we see in housing. And I think the short answer is that we see some really positive green shoots. We see inventory up. We see more homes selling at or below list. We don't see as many of those competitive bidding dynamics that have existed in the past. We know that the mortgage origination market this year is going to be about $1.9 trillion, and that's up 10 to 15% from where it was last year. So what we see is actually positive. Of course, it's anyone's guess how things will play out with some of those other dynamics like tariffs. But we see a lot of good things happening in the purchase market for the spring.
And so, Varun, these two acquisitions that you've made and what you're creating at Rocket, do you see it as more offensive or defensive strategy in this environment?
I think it's a little bit of both. I think, as I mentioned, the great thing about servicing is it creates a more counter-cyclical business dynamic where you can weather storms and grow in any market. So that's great. For us, this is definitely about creating a vision of where we want to see the experience go. We think together we can create an integrated, frictionless experience that drives value for consumers, that drives values for realtors, for mortgage brokers, real estate brokers. And I think fundamentally that's where we're focused. So I would say primarily we're doing this because we see an opportunity to build a better experience, remove friction, create value, pass the savings on to the client. So that's probably more offensive in nature than anything else.
And Varun, I guess the next question is, are you done? Because I was emailing with one analyst this morning who said on the servicing side, even this deal, even though it'll be a big company, an entity put together, it's still only about 20% of the overall market. So do you plan to make more acquisitions?
Yeah, I would say, first off, integration is our number one priority here with these acquisitions. Top priority for me, top priority for our board. We're going to be maniacally focused on making sure that this is smooth. I'd also say that we have some experience in this. Mr. Cooper has done a lot of deals very successfully. We've done deals successfully. So there's a playbook and expertise that we're bringing to make sure that this is successful. In terms of additional inorganic activity, I would just say we're going to be opportunistic. I think our number one focus is to make sure that these deals are successfully integrated, but our capital allocation principles stay exactly the same. And one of them is that we're going to be opportunistic when we think about M&A. One of the examples of an area that's interesting to us are what we call small tech tuck-ins. As you think about the AI space, there's a lot of advancements in things like computer vision, data and document extraction, optical character recognition, telephony and things like that. And so we're going to continue to be opportunistic if it's in service to our strategy. But of course, our primary focus now is making sure that these great companies, join Rocket and integrate seamlessly.
Varun, I remember you telling me when we first met, you're not actively glued to the stock price, even though we wish you would be watching it on the Yahoo Finance app. But why did it get hit on the Redfin deal, and why is it getting hit now? What has the feedback been from investors?
Yeah, look, I would say first off, I don't spend a lot of time looking at stock behavior on a day-to-day basis. I don't think it's indicative of kind of a clear strategy from a long-term perspective. We feel great about the story with our investors and our shareholders. We are building a generational company. We're very aligned in our long-term vision, and we think we're going to get there. And so that, to me, is the true test of value creation, is what happens over the long term. We feel great about our strategy with our investors and our shareholders. We have a lot of conviction that we're on the right path, and that's kind of our perspective.
Varun, thank you so much for your time. We really appreciate it. Brian, thanks for chipping in.
Happy to be here.
Thank you.
Great to see you. Thank you.
All week long on Wealth, we'll be breaking down how to manage the student loan process from applying to starting repayment. The free application for federal student aid, better known as FAFSA, helps the federal government determine how much aid incoming students are eligible to receive. As of March 17th, over 8 million FAFSA applications for the 25-26 school year have been processed by the Department of Education. I want to bring in Jennifer Finetti, Scholarship Owl Director of Student Advocacy. Thank you so much for being here. So let's start with the basics here. When is the deadline for this year's FAFSA?
The federal deadline for the FAFSA is June 30th. Excuse me. But each state has their own deadline that may be earlier or the same as the federal. And then on top of that, the colleges sometimes have their own deadlines. So it really depends on where you live and which college you're attending or plan to attend. It's a little bit of legwork for the student to find that out.
Yeah, so check the states, check the colleges. All right, and then what documents should parents and students have on hand when they're ready to apply?
So, you need to have certain financial documents. You need to have any income and asset information. If you receive child support, you need to have that information. You need to have your social security number, or if you are an eligible non-citizen for the FAFSA, you'd need to have your A number. And that pretty much accomplishes everything you need. You need to have your FAFSA ID number, things like that.
And what about after you make the application, what are the different types of aid that FAFSA can potentially qualify you for?
So you can qualify for federal or state grant aid. You can qualify for, of course, student loans, federal work study. That's pretty much it. And then, of course, you can also get scholarships. You can get institutional scholarships from the universities themselves, as well as private external scholarships like what we have on the Scholarship Owl platform.
And Jennifer, President Trump has said he intends to dismantle the Department of Education. Has the administration actually taken any action that would change things for FAFSA applicants?
The U.S. Department of Education is the administrator of federal student aid. So far, at least, there doesn't seem to be a change in federal student aid for students. However, this situation is fluid, so we don't really know exactly what the impact will be. However, students should submit their FAFSA if they have not already. And they should also focus on creating their own affordable path to college, which would mean applying for scholarships, applying for jobs so that they have a job while they're in school, and of course a summer job. These are things that students can do to avoid really focusing on something that they don't have control of, which is what's happening at the federal level. Also, they should really be thinking about choosing the most affordable path to college. For students who have applied for college, they need to make their admission decision by May 1st. So they should be comparing and contrasting financial aid offers they've received so that they can make the best choice for themselves, not just academically and personally, but especially financially.
And so what can students do if they're worried about potential changes to their aid? Is it some of the measures like you're talking about, or do they have any other sort of recourse here?
They can always appeal their financial aid offer if they're not happy with what they've received. It doesn't mean that they'll win their appeal, but they can try. Colleges do have a process for appealing that aid. And so you would need to contact your financial aid officer to determine what steps you would need to take to do that.
Jennifer, thanks so much. Appreciate your help.
Thank you so much.
Let's do a final check of the markets here. We're seeing a mixed picture continuing, with the Dow rising by more than 100 points, but the S&P off by 0.5%, and the NASDAQ, the worst of the three, off 1.3%. That's it for Wealth. I'm Julie Hyman. Thanks for watching.